Hey, Premier Investors, it's Adam Schroeder here with another episode, joined by my co founder, Grant McMillan. And we are pleased today to be joined by Bill Exeter. He is the CEO of Exeter 1031 and Exeter Trust. We're going to be talking about the 1031 exchange process. I know a lot of you have probably at least heard about it, maybe even done one, but we want to dive into the logistics of it, make sure you're dealing with the right people, make sure you're not making mistakes. So, Bill, thanks for joining us.
Thank you. Glad to be here. Glad to help.
Yeah, so let's go back in time. You've been in this space for a little while. Do you remember your first exchange you helped with?
Wow, that's a good question. That was almost 42 years ago. So no. Although that was back when I was in banking and the regulations hadn't even come out yet, and it was right after 1986 where that became one of the last remaining tax benefits of real estate. But we were doing maybe five a month, so few people knew of them that you didn't see very many transactions.
Yeah, so tell us a little bit about the space. Kind of, you've seen it grow up, like you were just saying. You were there whenever it started, and you've seen it grow up. Can you tell us a little bit about the space?
Yeah, absolutely. It's the first thing is it goes back right now almost 105 years. It was 1921 when the code came out, and at that point it wasn't even a Section 1031. And back then, most everything between then and say the 60s were concurrent closings, so the sales and the purchases all closed concurrently. Um, that was kind of the wild, wild west. I got into it in the mid 19, almost early 1980s, and the regulations still hadn't come out. So people got really creative back then. 1986 Tax Act came out, and that's where it eliminated a lot of the benefits of real estate. So the 1031 really kind of took off after 1986, and from there it's grown quite a bit. I guess one thing for listeners to know is that the 1031 exchange qualified intermediary industry has no licensing, no regulatory oversight capabilities, or anything like that. So QIs are just not licensed or regulated unless they go down a different path.
So why is that? I mean, you talk about it, and it is an industry. It seems like in the real estate space, especially, a lot of people are licensed, right? Like they manage all of that, and now you're talking about these people are involved in the transaction, um, fairly significantly. So, do you have any idea why it hasn't been?
Yeah, I'm one of the founders of the industry trade group, the Federation of Exchange Accommodators, and over the years we have asked federal and state regulators to regulate us, and the response is almost identical that the loss ratio is not high enough to warrant any kind of regulatory oversight, et cetera. I would disagree with that. I've seen a number of losses over those years, and almost all of them would have been prevented had there been regulatory oversight. The big one, of course, was Land America. They were the one of the big five in terms of title insurance, escrow, 1031 exchanges, and other services. And their qualified intermediary took the entire company down because of what they invested in. So regulatory oversight is critical, but they just don't want to regulate us. So the only way to get regulated is going down a different path.
Hey, Bill, I've got a question for you. We've got investors that are all across the spectrum of their real estate journey. We've got newbies, we've got experienced investors. So for those newbie investors, can you explain what like a 1031 exchange is, and also what a qualified intermediary is and what they do?
Sure. And I guess the best way to describe it is kind of with an example. So a lot of newbies, they'll buy, one single family home. They own it, rent it out. Somewhere along the way, they decide, hey, I like this business. I like being a landlord. And maybe they're ready to sell the one single family and then maybe buy a duplex or a fourplex or trade up. Or maybe instead of owning one single family, they sell one and buy two or three or four single families. So they diversify. And if they just sold that original single family, they would incur quite a bit of capital gain taxes, depreciation, recapture taxes, et cetera. So the 1031 exchange allows them to sell that original single family and defer the payment of all those taxes. So they don't have to pay capital gain or depreciation recapture taxes. as long as they reinvest in other investment properties. So they're really trading equal or up in value by reinvesting. And the IRS allows them to defer the payment of taxes if they do that. So it's really all about deferring the taxes, keeping all of their equity in their pocket, which makes it a lot easier to then reinvest in either more units, more properties, larger value properties, things like that. And the IRS does not allow the individual taxpayer to hold the money. So they've kind of set up this qualified intermediary. Some people call them accommodators or facilitators, and it's kind of like the quarterback in the 1031 exchange process. So we as a qualified intermediary, we plug into the investor's team. We work with you guys. We work with their realtor. We work with their title and escrow company or closing attorney. And our role is just to draft the documents, to structure the 1031 exchange. When the closing of their sale occurs, the funds are wired to us. We hold those funds until they're ready to reinvest in the replacement property. And then at that point, we'll wire the funds to whoever's handling the closing. So we're kind of very similar to an escrow company or title company or closing attorney. But the only thing we handle is just the 1031 exchange aspect of the overall transaction.
And to follow up on that, so for these newbie investors, when they're looking for, they've heard the phrase 1031, and they're trying to find a partner or an intermediary to vet. What are some things that they should be looking for when they're trying to find that partner? Because you've got options. Everybody's got options. We got everything at the click of a button on our within our pocket. So what should they be looking for when they're trying to find someone that can handle the 1031 exchange?
Great question. And it is funny. A lot of people just kind of Google something, talk to somebody, and they choose a company, and they don't really realize what the risks are. So I guess number one would be regulation. And we went down that path. We decided to better protect the clients. You've got to be regulated. And the reason for that is with regulation, you have regulators who come in and do an annual examination. They check everything. And that makes sure that you're operating in a safe and sound manner. You're following your policies and procedures. You're not taking undue risks. And with regulation, if you're doing something that you should not be doing, they're going to put you under either a memorandum of understanding or a cease and desist if it's really bad, and they'll close you down. So you can't take risks like other companies might. So regulation is, I think, number one. As I said before, all the companies I've seen fail would not have failed had there been regulatory oversight. So look for somebody who has some form of licensing or regulatory oversight. In our case, we went down the banking channel, so we took a couple of years. I mean, it takes a while, but we took a couple of years of going through the reviews and exams and background checks and all of that through the Division of Banking, and ultimately ended up with our own trust company charter, and that's Exeter Trust Company. So that allows us to hold the funds in a regulated entity. Having said that, everybody's human and they all make mistakes. So you also want to check the insurance and the bonding. And it's amazing that the investors who do look at that, they focus on fidelity bond. And fidelity bond is important. I mean, that's crime insurance, misappropriation of funds, theft, embezzlement, things like that. But that's not the most important. Everybody's human. They make mistakes. That's what happens most frequently. We do a lot of expert witness work, and most of the stuff we get involved with stems from, a qualified intermediary who made a mistake. It created a loss for the taxpayer, and from there it just got nasty. So you want to make sure there's errors and omissions insurance to cover the QI in case there's a goof and it creates a loss. You also want to make sure there's fidelity bond coverage. The big threat today is cyber and wire fraud. I mean, these hackers are getting really sophisticated in how they can try to change the wire transfer instructions and intercept emails and forward those on. So you want to make sure they have cyber fraud and wire fraud insurance as well. So those are critical. And then the third one would be make sure that the funds are held in a qualified trust account or a qualified escrow account. Those are specifically authorized by the Treasury regulations. And for those who want to do research, go back and look at the Land America 1031 exchange. The entire company was forced to file bankruptcy. The judge ruled that the funds were actually corporate funds, not client trust funds, because they were held in Land America's corporate name. Now that works from a 1031 exchange perspective, but when you end up in bankruptcy, not so good. And the judge also said, had they used a qualified trust or qualified escrow account, he would have ruled differently. So those are probably the three most important things to look at. Certainly look at longevity, how long have they been around, look at their online reviews, things like that. Use your judgment. Don't look necessarily at fees. I had a client call yesterday and they said, well, you're $100 more expensive than this other guy we're looking at. Yeah, but the other guy's not regulated. They're not licensed. They don't have the bonding that we have, et cetera. You're going to risk all of that for $100. That just doesn't make sense.
Right. Yeah, we like to look at value over cost. So the value that you get, even by paying that extra $100, is often way more worth it than going the cheaper route. So
Absolutely.
Yeah, I find it funny that you're having heard about the regulation. They call them qualified intermediaries. Whenever it doesn't sound like there's a whole lot of vetting to see who qualified is. But as you're going through, you mentioned kind of looking at all the licensing and the insurance and all of that. Is that something you can find online, or how would you search for that, or do you just call them and say, "Hey, send me proof of this, that, and the other"?
Yeah, I would certainly ask for proof. Some companies talk about it online. We certainly do. But, the fact that we put it on a web page doesn't mean that it actually exists. So you want to certainly get proof. So you can get an evidence of insurance, a COI. It'll show what the coverages are, and it'll list whether it's fidelity or E&O or professional or wire, cyber fraud, wire fraud, et cetera. So verify that. I would even go as far as calling the insurance agent and say, hey, I just want to make sure this coverage is really enforced, because anybody can create an evidence of insurance and fake it. So you want to verify that it's there. Trust but verify is always a good way to go.
Yeah. So what are you mentioned kind of some of the mistakes that can be made on the business side. What are some of the mistakes you see clients making whenever they're going through? And can you actually, before you dive into that, talk about, there's three different types of exchanges. Can you dive into those a little bit? Just kind of explain them on a 30,000 foot level, and then talk about some of the mistakes you've seen clients make that aren't your fault. You probably tried to get them to avoid them, but that they do continually make.
That is so true. Yeah, in terms of the different types of exchanges, the three kind of major categories, if you will, is one is a forward 1031 exchange. People call it all sorts of things: forward exchange, delayed exchange, tax deferred exchange, 1031 exchange. It all means the same thing. And that's where they're selling their relinquished property first, and then they reinvest in their replacement property second. That is 96% of our transaction volume. So by far, that is what most people do. The other 4% fall into the other two categories. So the second category would be a reverse 1031 exchange. The reverse exchange, of course, allows them to do the reverse. They buy their replacement property first. They can actually close on the purchase first. They know they've got their new property lined up and ready to go. And then they have the deadlines, the 45 days to identify what they're going to sell. That's just a formality generally. And they've got the 180 days to actually close on the sale. So they got their new property locked up. It takes a lot of the risk out of the 1031 exchange because you're buying first. But it's a lot more expensive, a lot more complicated, which explains why that's only 4% of the transaction volume.
Yeah, and I assume you would also have to have the funds to close on that first, and then do you just get reimbursed from the exchange account after it closes?
Effectively, yeah, that's pretty much how it works. There's variations there, but that's a great question. It's amazing how many people will call us and say, so you guys front the money for us to buy the property? Like, no, we don't do that. So yeah, they would have to somehow buy first. And one of the requirements is we have to acquire and hold, or what the IRS calls park legal title to the new property. So most traditional lenders will not touch that because we're on title. I mean, the client's really the real buyer and the real borrower, but we're on legal title during the reverse exchange. And traditional lenders just won't touch that. So that's also one of the complexities. The third area is what we call improvement or build to suit or construction 1031 exchanges. You don't see a whole lot of those because of all the timing requirements. But effectively, you sell property, you use some of the proceeds to buy the replacement property, and you use the balance of the net proceeds from the sale to make capital improvements to the new property. The challenge is you've got 180 days to do that. And so sometimes, like here in California where I'm located, getting a permit in 6 months could be a miracle. So it just depends on the jurisdiction. And if everything comes together, it's very doable, but it can be a little rough.
All right, and so what are the big mistakes you've seen clients make along the way? I'm assuming a lot of it is hitting deadlines, but are there any other big ones that you've seen?
Yeah, you hit the nail on the head. So the advice I always give clients is get your team together up front. Whatever that means to you. So get your title company, your escrow company, or your closing attorney. Get your real estate agent. Um, you know, Working with you guys makes the replacement property process a lot easier. So get you guys involved up front. Start looking for what you might want to acquire. And if you get it all together, it's all about timing and then get all your ducks in a row, get the timing in a row, and then you can execute fairly quickly. Most clients don't, and that's where they fail. Is they just they start to list the property, they go under contract, maybe they open escrow or work with a closing attorney, and then when the closing occurs, that's when they start looking for property. And it's like now you got 45 days. It gets very stressful. And then some folks just can't find property, especially in today's market. It's a crazy market. So trying to find property can be difficult. The other part is they mess up on the identification process. Now we review the ID forms. A lot of exchange companies don't. So we'll review it. If we see any problems, we'll go back to them and say, hey, you got to fix this. But if the client emails us or faxes us the ID form 1 minute before midnight on the 45th day, we're not going to see it until the 46th day. A little hard to correct mistakes at that point. So the identification process is part of it. They want to get as far along in the process as possible. If they wait to go under contract and all of that till after the 45 days, what if the property falls out for some reason you can't buy it? Then you're in trouble. You can't go back and change your ID form.
And whenever it comes to the part, you can, to my understanding, you could potentially even go under contract on something, send the earnest money in, and then when you close, y'all swap out the funds, right? And then it's one of the more ridiculous things that I've seen. It's like, why don't you just send the funds to me since I've already put 10,000 or whatever in escrow? But you can swap it out, right? So you could actually be under contract on a property before you close your 1031 exchange property that you're selling.
Absolutely. Yeah, they can negotiate, go under contract. If they're in an escrow state, they can open escrow. As long as they don't close on the purchase until they've closed on their sale, absolutely okay. In a lot of cases, since the sale hasn't closed yet, you're absolutely right. They're going to have to put the earnest money deposit down out of their own pocket. The key there is once they've got their sale closed, we're holding the 1031 exchange funds. Then we can assign the purchase and sale agreement for their new replacement property to us, and we step into their shoes as the buyer. And then at that point, we can fund the earnest money deposit and then instruct the closing agent to refund it back to whoever funded it originally. But that's key. The purchase and sale agreement has to be assigned to the qualified intermediary first. So the QI becomes the buyer, and then they can fund the closing account with the earnest money deposit and then instruct them to refund it. If the client says, hey, do this before we're assigned in, that shows the client has control, which is what they call constructive receipt of the funds. The entire exchange would become taxable.
Hey, Bill, as we get close to wrapping up, I've got one more question for you. For those that are going through that first 1031 exchange, what is one piece of advice? We've kind of touched on a few different items, but what is one thing that absolutely they have to do prior to completing this exchange?
Great question. Most important is get the 1031 exchange set up before the sale closes. I mean, literally, no kidding, we get calls every single week where they say, I closed yesterday or last week or what have you. And maybe it's, I just found out about it or my accountant just told me. We had a client last week who said, my CPA said, as long as I identify within 45 days, I'm okay. And he closed already, and there's no way to go back and fix that. So make sure the 1031 exchange is set up prior to closing. And with that kind of goes along with what I mentioned before. Get your team together, talk to people, especially talk to your qualified intermediary. Make sure you got all your questions answered, that you don't miss anything. Otherwise, things you miss in the 1031 world create a tax consequence.
So whenever it comes to, I'm looking to sell a property, right? I've owned it for a few years. I think I can sell it for a little bit more. and potentially scale up. But not every property makes sense to do a 1031 exchange with. So whenever you and your team are looking over a property, how do you determine, okay, this one makes sense, on this one, just, sell it and take the tax hit? But how do you decide what properties actually make sense to do a 1031 exchange with?
Great question, and that's the most important part with that topic is to talk to the tax advisor. The client, and I would always recommend that. Talk to your tax advisor first. Know what your tax consequences are. In some cases, you may find that you have 10 or 15 or $20,000 gain. Is that worth doing a 1031 exchange? And some people would say yes. Some people would say no. So it's really a question that depends on the investor's preference. But certainly know what the tax consequences are. That way you can decide if it makes sense, if it's worth it. To me, if it's a $20,000 gain, I'd just sell the property and pay the tax. It's not worth going through all the headaches you have to go through to defer $2,000, $3,000, $4,000 in taxes. But other people would disagree with that. So that's probably one of the big ones. Know what it is. And then we get folks too who say, well, I didn't do a 1031 because I have no capital gain. And then when they file their tax return, they find out, well, I owned it for 30 years. I have a huge amount of depreciation recapture. So again, talk to your tax advisor, make sure you know what your tax consequences are going to be, and then you can decide from there. But normally it's going to boil down to how much gain do you have? How painful is it going to be if you just write a check to the feds in the state?
Yeah, especially if you've done a cost segregation or something on the property that's made your taxable amount, your depreciated amount a lot higher. It could be that you don't need as much gain to make it worth it along the way. So, do you have a horror story you could tell us that comes to mind at all? I mean, I know it's not the most exciting. If you have a horror story or something where y'all came in and kind of saved the day. I know I've talked with investors who it's kind of like what you were just saying with the coming right away. They've said, "Yeah, I'm going to do a 1031 exchange." And I said, "Okay, who's your intermediary?" "Well, I don't. What's that?" I said, "Okay, well, we need to talk." And it's like, "When are you closing?" "Well, I'm closing in 2 days." "No, you're not. You're going to kick that closing down the road a little bit, and you're going to talk to somebody." But if you have a horror story or a great success story, I'd love to hear it.
Actually, I have two fun stories that kind of just, they're fun. One is before the 2017 Tax Act, 1031 exchanges would also qualify for real property and personal property. So personal property would mean like aircraft, shipping, trucking, livestock, whatever. And probably my most fun one was a aircraft exchange where the attorney said, we do not want to do this exchange in U.S. We want to do it in international airspace. So we all got to get on the 747, fly out to international waters, do the actual exchange, initiate the wire transfer, et cetera, and then fly back. And they did not let me fly that sucker. Can't
That's
imagine
just
why.
rude.
It's rude. So that was probably the most fun one. And then the kind of the most odd one is we got a call one day from someone who asked if they could exchange a meteorite. And, we thought it was a crank phone call at first, but they were asking really good questions. And as it turns out, he has a meteorite. He essentially got it for free, so there was no cost basis. And out of the blue, an investor offered him $1 million for it. So he said, I've got $1 million gain sitting here. What can I exchange it for? So that came down to what's like kind property. And, so at the time we said, well, obviously, if you exchange for other meteorites, that would be like kind. Would something like, minerals of some type or gems or whatever, would those, who knows? I mean, the IRS has never ruled on a meteorite. So that was one of the most interesting exchanges we did. I had made a comment like, well, who would exchange for other meteorites? He goes, well, I would. Like, okay, my bad. So that's exactly what he did is he exchanged for another, I guess you call it a portfolio of smaller meteorites. I don't know.
Wow.
I don't know what
But
the depreciation recapture is on that, but
yeah. So those are probably the two most fun stories that I've got. The 2017 Tax Act took all that away. Now only real estate qualifies.
now, is it only U.S. real estate, or could they go out and get something in a foreign country whenever they sell?
Great question. They First of all, what you see on the internet a lot is they'll say things like foreign property cannot be 1031 exchanged, which is not correct. What they're really telling us is that you can't sell foreign property in 1031 exchange into U.S. property, and you can't sell U.S. property in 1031 exchange into foreign property. But if you've got a client who owns rental, investment, or business use property in a foreign country, and they're going to sell that, it will likely trigger a U.S. tax consequence. So you could 1031 exchange, but you have to buy another foreign property. So it does have to be foreign property for foreign property. And the 1031 exchange would only qualify to defer the U.S. federal tax, not whatever the local jurisdiction is, of course. Foreign countries, whoever the closing agent is, they often think it's money laundering. So we have to get past that and convince them, no, it's really part of the U.S. tax code and it can be done and what have you. And we've done it in about 45 different countries at this point.
Oh, nice. And can you talk a little bit about the boot potential of it? And then you can actually buy more. So if I'm making like $100,000 and as that I need to exchange, I could buy something where I'm putting in 120,000. I just have to kick in the extra 20, right?
Absolutely. So most people actually do trade up in value. So if you sell for 100, maybe they buy for 120, as you said. The $20,000 difference, you're trading up. That could be new debt, out-of-pocket cash, whatever you want. And most people do trade up either a little or a lot. It's a great way to take your current equity and kind of diversify and build your wealth. Contrary to what you see on the internet, a lot of times you'll see things that say you have to trade equal or up in value, you have to reinvest your equity, you have to replace your debt. They mean well because they assume you want to defer all your taxes. But you could do a partial exchange, which is what you alluded to, which is you could trade down in value. You could pull cash out. That does not hurt the 1031 exchange, but you're probably going to pay some taxes. It depends on your tax return. So, for example, you may, in your example, maybe you sell for 100,000 and you buy for 80,000. You trade down by 20, and of course, we're ignoring closing costs. But that 20,000 is going to be considered boot. It's taxable boot or taxable gain. Now, you may have other items on your tax return that would offset that. Different kinds of losses might offset that. So it may not actually be taxable, but technically you've traded down. So from a 1031 exchange perspective, that would be taxable boot. And then whether it's taxable or not depends on the rest of your tax return.
Now, are closing costs able to be included in your 1031 exchange?
Yes, although not all of them. So it's what we call your routine permissible exchange expenses. And that's most of them, like your broker's commission, title, escrow, closing attorneys, documentary transfer tax, recording fees. Those are your routine selling and routine purchase expenses, and those can be subtracted on the sales side and added on the purchase side. Anything that is an operating expense, prorated rents, prorated property taxes, HOA fees, those type of things, those aren't closing or selling expenses. Those are operating costs. So those cannot be deducted. Most people pay those through the 1031 exchange or through the sale of their property, but that will trigger a small tax consequence because they're using 1031 exchange proceeds to pay for non-replacement property costs. But I'd say 80-90% of the clients just pay it through anyways, and it's not a big deal. And then, of course, any financing costs, so lenders' fees, lenders' points, interest, those type of things are not permissible. Again, most people do the payoff through the sale. It's going to trigger a little bit of tax consequence, but it doesn't hurt the 1031 exchange.
All right, fantastic. Well, Bill, I want to thank you so much for joining us today and educating. I mean, I've been in the space a long time and do a lot about 1031s, but I definitely learned new stuff here today, and I hope everybody who listens will. Tell us if you have any parting thoughts, but then tell people how they can get a hold of you and all the services y'all provide.
Sure, absolutely. A parting thought, I'm going to go back to what I said before. Get your team in place up front, talk to your tax advisor. Really, I mean, they may charge you for the advice. It is so worth it. Find out what you're looking at, know what you're looking at before you make the wrong decisions. And then to get in touch with us is easy. Our website is exeterco.com. So that's EXETERCO.com. You can also email me at wexeter@exeterco.com. or you can give us a call. We're headquartered in San Diego. We've got offices throughout. But my number here at the San Diego headquarters is area code 619-239-3091. And then our services are we do the 1031 exchange, of course. We do self-directed IRAs and self-directed 401k plans for those who want to buy real estate related assets, private entities, private equity, private debt inside their IRA. We handle that. Because our trust company's headquartered in Wyoming, we can also do the directed or administrative trustees for those who want that type of a service. And then we act as custodian and administrative custodian, if you will, for private equity funds, private debt funds, things like that.
Fantastic. Well, we will have all of that information listed in the show notes for anybody who didn't have their pen and paper ready whenever he started rattling that stuff off. So thank you so much again. For everybody else, don't forget you can find some properties to invest in to offset your capital gains when you're doing your 1031 exchange at premierturnkey.rei.com. That's premierturnkey.rei.com. And remember, you can live how you want when you invest where it's smart.